Hey guys, welcome back to my session, Stock Simplified, and let's work together to make understand stock much better. This is a continuation to the last video that we made on return on capital employed, and I hope that you guys understood it and tried applying it on a few stocks. So let's move forward with the second criteria. That was the first criteria that the ROC of any company should be more than 20%. Now, coming to the second criteria that we should look at while analyzing any company. So, on the screen, this criteria two, while analyzing any company, will be income growth. Will be income growth. Now, why income growth is considered such an important factor? Let's say point number one. You can pause the video if you like. You can just think about it. Okay, cool. Now with income growth, what happens or what comes to my mind is the business of a company is growing. It is growing at a standard rate. For example, I was doing a business of 50 crores in the first year, and in the next subsequent year, I'm doing a business of 60 crores. So that is a growth of 20% in my business. Now to increase that 20%, I would try either of the two things. Either I would increase my prices, that means I am producing the same number of quantities at a higher price. That is a way that my sales can increase. The INR figure of the sales can increase. And the second fact is, if my either I increase the volume. To increase the volume, I would require capacity enhancement, in which must have diversified, or I must have opened up new outlets, factories, or anything of this sort. Now, for our criteria to best fit in this situation, we have taken a parameter like the which I have followed personally while I was investing. The parameter that I have taken is that the income growth for any company, let me just any company should be 15%, 15% for last 4 years. Like we had talked about, that it should be for ROC, we had taken 20%. Similarly, we have taken 15% for 4 years. This parameter is going to remain the same for most of the concepts, until unless I specify that particularly that we have to just look at it from that year's point of view. Okay. Now, income growth for last 4 years should be 15%. This the criteria number three. We'll take the working of it step by step. After, you can just jot down these points. The criteria three should be profits growth. Profit growth, here I'm talking about profits growth in term of net profit. Net profit should be 18% per annum, year on year 18%, and that should be for the last 4 years. Again, this is this is a criteria again that we have to follow. I'll just bold the same. Cool. I think that you can. Criteria number two was income growth. That means the sales growth. Sales growth of any company should be greater than 15% for the last 4 years. The net profit growth should be greater than 18% for the last 4 years for any company that you're analyzing. So first we are going to look at the ROC. Then criteria two, we come if ROC fits, we're going to look at the income growth. Then if the income if the company fits in that criteria of income growth, we go to the third criteria, that is the net profit growth, that we can take it as 18%. Now, how do we see income growth and profits growth in a company? So let me just I'll just open up my browser. It is opening. Okay, now I can just search any company. For example, we take Asian Paints. We take Asian Paints. Now we have Asian Paints here. And now here you can see, just to ease this process, here is the profit and loss statement. Here are the sales figure as you can see for March 2018 and March 2019. Ma- these are the figures that we need to quote consecutively for the last 4 years. That means we have to take figures of March 19 versus March 18, March 18 versus March 17, March 17, 16, 16, 15. So 1, 2, 3, 4. 4 years are complete. Now we'll just look at this. The March figure here are 19,000. We should look at standalone. Okay, cool. Now March 19 figure is 16,392. 16,392. Now I come down. It is 16,392. 16,393. That doesn't make sense. This is March 19. And then March 18 is 14,168. This is March 18. Now we get this. Now we'll just have to, this is simple maths. This is 15.70%. Luckily, this company falls in the category which we have specified, that the income growth should be more than 15%. So this is marginally high. We can consider this company if we are really working or researching on this company. Now we have to take this ratio continuously for last 4 years, and this should be greater than 15%. Now coming to profits growth, how do we go about it? I've explained you income growth consecutively. You can do the same for the last 4 years. Now let's go to the side. Profit side. Net profits. Here it is 22135. So profit, it is two one 2135, and this is 1895. 1895. If I just copy this here, this is 12%. Uh, it did not fall in our category, so it's okay. This was just an example. The net profit growth is 12.66%. Okay, we'll see to it that we'll see in the subsequent sessions that what are the factors that really influence. For example, the income goes up by 15%. That means when our income, this is common, a logical question, that if the income is growing up by 20%, why is the net profit going up only by 12%? There are other expenses that a company incurs. For example, its salaries, its interest, its loans, the interest on its loans. We'll discuss each one separately. For example, if we take this forward, and I just I will just export this to Excel, then we can primarily know the reason why this has happened. Cool. Now here we come. I have just got those figures into Excel. I hope you guys are able to follow. Percentage of, now let's see March 2019 and March 2018. So this comes to be, if I just take normal, this is 16%. Now, let's see what happens here. How do we analyze this? Analyze this in terms of percentage. The reason that we want to find here is, if the income went up by 15%, the profit should have gone equally. Then why are the profits less? So we'll just answer this here. This I'm saying it on March 2000, wait, March 19. Let's say this is March 18, and we have to find out the figures. Wait. Now let's compare these two figures. I think the things are visible now. I'll just enlarge it to make the things even more clear. Now, let's see. The sales went up by the sales went up by 15%. Here the sales went up by 12%. So we have improved. This is a good sign. Now, the expenses were 12% as on March 2018, and they rose up to 16% in March 2019. Then what is there? The expenses have increased. Now, as per my knowledge, like, this is a paint industry, and the manufacturing of paints is directly related to the crude prices. So there must have been a factor which we have to find out in the annual report, that was the crude prices really played a did the crude prices really play a bigger role in driving the expenses high? So here we need to work. This is how we analyze. Operating profits were higher as compared to the last year, so this is again a good sign. Other income was in negative, here it is in positive, again this is a good sign. Depreciation, the company has charged depreciation, so that is okay. We'll discuss this separately, depreciation point. The company has paid very high interest. Now we need to work here. We need to work here. Why? The company has paid 6.82% interest in March 2018 and 34.93% interest. If I look at the figures also, as on March, 32.14 crore against 23 crore, and 23.82 crore against 22 crore. So here the interest has increased significantly. So we need to see that, has the company taken additional loans for which it had to service? Profit before tax no doubt has increased. After tax, the net profit has gone up. The net profit was 5.75% here, and it has gone up to 12.66%. So this is a good sign if we consider this year on year. Now for EPS, we'll have a separate session for this, but now, here what I want to convey is, why did the sales figure did not match with the profit after tax figure? It did not match with this because, number one, the expenses went up high. That means we paid more in we paid it may be related to anything. We really have to work with the annual report of the company. We need to get into the notes of accounts. In the profit and loss statement of the company, there are notes to those accounts that are given. We really have to see where did the cost go high, so that we can ascertain whether it will be a good investment or not. And interest income, will have to check whether the company has taken any kind of a loan, additional loan, and what is the rate of interest which it is serving. The debts of the companies are increasing. So these are the 2 points that we need to see. So here again, to revise, what did we see? We saw that first we need to see at the sales growth. It should be greater than 15% year on year consecutively for the last 4 years. Then we need to see that the net profit after tax, should be greater than 18% consecutively for the last 4 years. Now, first criteria, if we see that the in order to introspect more, for example, a person wanted to introspect more, that's why we had this additional understanding of what to see if the sales figure are not matching with the profit after tax figure. So I explained this, that expenses have increased drastically if I consider year on year growth. Then the interests have increased drastically if I consider the year on year growth. So that's why they will have to analyze this more deeply if we really have to get into where did the company pay additional interest and where did the company incurred extra expenses. Is that cool? Now let's get back to our sheet. Fine. So we had three concepts here. This is a concept that we covered: annual year on year profit and loss statement. Cool. We'll cover this separately, but I just compared the profit and loss statement of 2 consecutive years. So we can just take it that we have covered a less portion of this. Okay, now the above criteria that we have talked about works for companies except NBFCs and banks. What is the criteria that we need to look at while considering N banks? Just hold on. Banks and NBFCs. For banks and NBFCs, the very first criteria that one needs to consider is income growth. What does the bank earn? First of all, we need to understand that what does bank or NBFCs, they lend their money, they give it to the people, they give it on interest. The interest earned by the banks consecutively for the last 4 years should be greater than 15%. Now, what do we infer from this? The income growth increased means the bank cannot charge a higher rate of interest to the existing customers, means the loan book of the bank must have increased, correct? So here also we are talking about growth. Okay, this will be criteria number one while considering banks and NBFCs, and criteria number two will be net profits after tax should be greater than 18% and above consecutively for the last 4 years. I'm reiterating the fact that for all the criterias that I'm telling you, they should be consecutively for the last 4 years. Now, profits, we'll just see a working of this also. We'll just look at it a little fast. We'll again get back to our, say, HDFC. Here comes HDFC Bank. Here comes the profit and loss statement. So here here you have the values as on March 2019. It is 1 lakh 5,161. As on March 2018, you can get these figures from here in the same manner as we did for the previous section. And the net profit you can see here. This is the net profit. Net profit, I think I'm just highlighting it. Again, I am reiterating the fact that you need to consider this for the last 4 years. Now, let's just revise what we have done so far. We have gone through ROCE. We have gone through income growth. We have gone through net profit after tax. Now for ROCE, we took it as 20%. For income growth, we took it as 15%. And for net profit after tax, we took it at 18%. Now, while analyzing any company, per se, you take any annual report, any balance sheet. Now, if any Tom, Dick, and Harry wants to tell you that, dude, invest in this company. Now, by looking at these three ratios only, you will know that whether this company is profitably generating any amount of profit or not. ROC, obviously, that was a very logical ratio that we explained. Then it was income growth. With income growth, that means it is expanding its business. In case of banks, whether it is expanding its loan book. Then net profits after tax means the income. Now, why do we need to check the net profits after taxes? Because to increase that income, it has to justify. Suppose I am generating a income growth of 40% every year, but my net profit after tax is increasing by 10%. That means I have huge expenses. I am incurring a huge cost and my business is not feasible. Why will I grow at a 40% rate compounded annually every year and just get 10% return out of it? That is not a logical statement. Okay, now let's come to the next concept. The next concept which I want to make clear here is, I think you guys must have noted this down, is debt equity ratio. Again, this ratio will be applicable for companies other than banks or NBFCs. What is debt equity ratio? Debt equity ratio is nothing but the total debt of a company over the net worth of the company. It should always be, always. I personally prefer only those companies where the debt equity ratio is less than 0.3. I think this is visible. I'll just bold the same. Debt equity ratio should be less than 0.3. Now let's analyze this with the help of an example. For example, I don't know what this happened. For example, the company will explain this why debt equity ratio should be less than 0.3 or no debt. I generally prefer company with zero debt. Now let's analyze why do we consider this. Scenario 1, a company in the year 2000, a company generated a sales of 100 rupees. Its expenses were, say, expenses were 40 rupees. Its operating profit comes down to 60 rupees. Now, this is just the profit and loss statement that I'm going through. Now, the company has huge loans. It has taken, say, it is serving interest. It has taken huge loans and it is serving interest of, say, 40 rupees. Cool. Now, then depre depreciation that is charged, say, 5 rupees, which a company generally charges. Then what is left? 60 rupees is the operating profit. Now I subtract 60 rupees minus this. I take this at interest rate as 30 in order to make the things more understandable. So this is my profit before tax. Fair enough. This is my profit after tax, say at the rate of 35%. I pay equal to this into 0.35. I pay 8 rupees in tax, and what I get it is 16.62 16.25 rupees is what I take home. This is my net profit. I'll be enjoying in this situation. I'll be very happy. But God forbid, there a situation comes. For example, there was a recession in the year 2007. Year 2007. All the business tend to go into a cyclical phase where at a certain point of time they either they need to get into a different life cycle, or their business shrinks, means the demand slows down. This happens like in the year 2000, there was the dot com crisis, or in the year 2007, there was this Lehman brother that crashed. Then there might be, currently it is Corona that is going on. So what happens is, if the sales decrease, now I say a scenario, that is, I'm just taking a scenario of 2007 where the demand of the products went low because the purchasing power of the customers shrank because there was no liquidity in the market. So suppose that the sales of this company came down by 30% or 40%, say 60 rupees. The expenses could have, fixed cost would remain the same. It might lay off some employees, the expenses would go down to say 30 rupees. Fair enough. What is the operating profit? 30 rupees here. Now I'll have to pay. I have those loans that I've been carrying forward. So I have to pay interest on those loans. So that interest will remain the same. Depreciation I charge say 2 rupees here. What will be my, this is the point that I want to make, that when the business cycle reverses, your profit before tax gets negative. That's why we need, and why did this get negative? Because of the interest cost. The company was not able to pay even the interest of the loans that it had taken. That means the company is going to get into default. That means again it's going to file bankruptcy because it will say that it has gone bankrupt. That's why I prefer companies that have debt equity ratio less than zero point 0.3. You got the point, guys? Now, imagine the situation where this company might have had very less debt. Say the interest payment that it was supposed to make was just 5 rupees. Still, it was, look at the profit before tax figures. They are almost the same, despite there being despite there being a 40% drop in the business. Here, no doubt you have taken a lot of loans, you must have had a lot of capital. But at the same time, when the business cycle reverses, that interest becomes a very big burden for the companies. That's why I generally prefer companies where the debt equity ratio is less than zero point 0.3. So, guys, this is criteria number 4. This is for companies except banks and NBFCs, that the debt 0.3. Now, where do we find the debt equity ratio? Let's take that. Now I go to my, you can easily get it from any of the websites if you want to. They give you a fair enough idea. But if you want to really calculate this, we'll take a separate calculation of this in the next session, since we have a limitation of time here. Then, or you can just go on to, wait. Let me just see. For Okay, we'll take the working of this in the next session. That is the debt equity ratio. We'll take it in the next session. Now, criteria number 3 for banks and NBFCs, because this cannot be applied to banks and NBFCs. Criteria number 3 for banks and NBFCs, what do we say? Net NPA to advances. A bank, what is the very first thing that we have seen in a bank? We see the income growth. That is, if the income grows, the loan book grows. If the profit grows, means the expenses are in control. Now, what we need to see is the asset quality of the bank good. For that, we need to see is the net NPA. NPA is nothing but non-performing assets. The banks give loan to a lot of people. Some 99%, or say 95 or 96, 99 in some cases, customers repay back. But there are some people who, either because of their business situation, some people because of their intention, I don't want to quote intentional defaulters here, but banks, after giving certain loans, they are not able to recover that money. So that is termed as NPA. Now to look at the NPA and how do we analyze NPA? We analyze NPA year on year. Year on year, how do we analyze? For example, the NPA, the net NPA to advances for any XYZ bank was 0.39. 0.39. Next year, it has increased to 0.45. Then that is an alarming size, because it may sound that this is just a mild increase, but this mild increase is on the overall book of the bank, and bank is just earning interest on such a large book. For example, a bank has a total book of 1 lakh crore. 1 lakh crore, the percentage that if we take, what is 0.39%? Sorry, we just, this is 0. 390 crores. Okay, 390 crore is the loss of a bank. If this was the case where the net NPA to advances was 0.39%. Now, when it increased to 0.45%, now let's see the difference. It has gone up to 450 crores. Now, look at the look at the difference. 60 huge crores of increment, which is going to cost the bank in its net profit. So you really need to monitor whenever you look at a bank. You have to look at from an income perspective point of view, that whether the income is going healthy, that means 15% per annum. At that tune, is the profit growth growing healthy, that is at 18% per annum. And at the same time, and most importantly, the bank is doing business, the bank is making profits, but at the same time, is the asset quality of the bank high, or is it healthy? How do we know this? From the net NPA to advances. You can even take gross NPA in this term. For gross NPA, you just get these figures in the annual report of the company. We'll just look at it. How do we get this? For example, say, what is this company? HDFC. Okay. We'll just open the annual report. Just hold on. We haven't got this. Let's open it again. Net NPA to advances. Here I've just searched it because it's a very huge document, so I've just searched it via net NPA to advances. That is 0.39. As on March 2019, it was 0.39. As on March 2018, it was 0.40. That means the bank has considerably improved its asset quality. As you can see here, I'll just increase the font size. The bank has increased its asset quality here, and this is very good sign for a bank. If a bank is increasing its income, if a bank is increasing its profits, and at the same time it is maintaining a good asset quality, then that is a very good sign from a bank's point of view plus an investor's point of view. I'll be very safe. What, the business is robust, the bank is giving its loans, it is collecting money back. If I invest in that company, I'll make my money may go many folds. It can go 5x, 10x, 15x till the bank maintains this. So I think this point is also clear. So today what we have done is, now we have four concepts, that is ROCE. We'll just revise that. ROCE, we have income growth, we have profits, we have debt equity, then we have, in case of banks, we have net NPA to advances. You can search the net NPA to advances in the similar fashion as I have done. In case of quarterly results, on the BSC's website, they specifically mention what is the percentage of the net NPAs at the right, at the bottom. So you can take it from there if you analyze quarterly results, because obviously if you have made an investment, you will try to analyze the results quarterly, like what is the performance and everything. So you can directly go to the BSE website where the results are published, and in that also net NPA is mentioned. Cool. So this is it with this session. In the next session, we are going to take up the working on the debt equity ratio. And I hope you like what we have studied so far, and just try implementing what I have just told you. Take different companies on different website, or the website that I've been using, and try to get as many questions as you can, because at first time you'll have a lot of questions, that why is this. You can post the same in the comment section. Rest, if the video is helpful to you and it's making investment simplified for you, please like, share, subscribe, and let's catch up again on Stock Simplified. Thanks a lot.